much has happened across the global screen. Here's a special conversation with Dr. Marc Faber on where he sees things headed and whether equity markets look like they're getting into a bubble zone.
Well, basically, we have had huge fiscal stimulus packages and we had quantitative easing in basically all countries around the world. And so asset prices have recovered strongly after March 6th of this year, with stocks rising, commodity prices rising, and the dollar weakening again. And each time the dollar weakens, it's kind of a symptom of some inflation in the system and excess liquidity building up. And what we have is large cash positions around the world and zero interest rates. So these zero interest rates and also policy by the Federal Reserve to keep them at a very low level for a very long time, as was the case after 2001. With this in mind, money goes out of cash balances into something, either consumption or into some kind of assets such as equities, commodities, bonds or art or real estate.
While the rally has been intact, Dr. Faber, there seems to be one concern, which is that interest rates will soon start moving higher and that will in turn start sucking the liquidity out, or the easy liquidity out. Is that a real fear for markets?
I don't think so. I think we have to distinguish between short-term interest rates and long-term interest rates. Long-term interest rates, the Federal Reserve does not really control them in the long run. Temporary, they can control them somewhat through quantitative easing and through the purchases of 10-year bonds, 7-year bonds, 30-year bonds. But what they control are short-term interest rates, in other words, the Fed fund rate. And in my opinion, reading through the literature and reading through the speeches that are being given by Mr. Bernanke, my impression is that the short-term interest rates will stay long for a very long time, because don't forget, in America the fiscal deficit this year will be around $2 trillion. And I don't think they can actually cut the fiscal deficit next year, because if they cut it, it will have a negative impact on the economy. So I rather think that the fiscal deficit will stay at this level, or in my opinion actually even increase. And that will lead the Fed to keep interest rates artificially low, because should they increase short-term rates meaningfully, then the cost of servicing the government debt in the US would escalate substantially. So I think as far as the eye can see, monetary policies in the United States will stay expansionary.
We'll talk about sectors and markets in specific in a bit, Dr. Faber, but what about the dollar? There has been almost a straight line correlation between the way emerging markets have moved and the way the dollar has been weakening. Do you sense that is going to snap back soon?
Well, I think that if I look around the world, and this is frequently missed in the inflation-deflation debate, the US current account deficit growing from $150 billion to $800 billion between 1998 and 2007 flushed the world with liquidity and led to essentially inflation in emerging economies, in particular asset inflation. I mean, we have now flats in Hong Kong, in other words condominiums, selling for up to $9,000 a square foot. In America, the price level compared to the price level in some of the Asian cities is actually now quite low. So I think the US dollar is no longer overvalued for the time being, and the sentiment about the US dollar is so negative that we could have a rebound in the dollar for a couple of months, and that would indicate some tightening of global liquidity and be bad for asset markets, as was the case in 2008. When the US dollar rebounded, all asset markets went down.
If there were to be a snapback, how powerful do you think it might be? Are we talking about a big pullback for the dollar, considering how much it's sold off these past few months?
That I doubt, because the Federal Reserve and the US government pursue policies that are not conducive to a strong US dollar. But as I said, we are very oversold and we could see some rebound, maybe in the order of 10% or so. But I wouldn't expect the US dollar to be structurally a strong currency in the next few years. Quite on the contrary, I think the US dollar will continue to lose its purchasing power.
While a correction has been called for many months now, do you see a situation over the next few months where liquidity can actually push markets to far higher levels and see almost a blowout-like rally over the next couple of months?
That I doubt. We're very overbought and the economic news is not particularly good. So I think that before we would rise much more in equity markets, a correction should actually take place. But markets are unpredictable and it is conceivable that there is kind of a blow-off phase before we go down substantially. But I wouldn't bet on that. I think the big move, the gravy is out. We're up 100% in India, we're up 50% in the United States. Maybe we go up another 10%, but we're not going to go up another 100% straight away.
As you watch the markets right now, do you see any similarities with the situation that we had in 2007? And just by extension of that, if there is indeed a correction, who do you think will falter or blink first? Will it be equity markets or the commodities or a completely other asset class?
Well, I think that equities, after the peak in October 2007, collapsed around the world by plus minus 50%. And now they have rebounded, but they're not at previous highs. In the meantime, in some countries, companies have continued to increase their earnings. And so the valuations are not as stretched as in 2007. But what disturbs me personally is that we had the financial crisis. The cause of the financial crisis was excessive debt growth. That was essentially produced by, notably, the American Central Bank, the Federal Reserve. Now, the same people who produced the crisis, namely the policymakers in the US, they're still in charge. And if you look at what has happened in the US over the last 6 to 9 months, nothing has been solved. It's been postponed through fiscal and monetary measures, precisely the measures that brought about the crisis in the first place. So I think enjoy your ride in asset classes as long as it lasts. But I think we are seeding the next crisis, and it may happen in 3 months, maybe it happens tomorrow, maybe only in 5 years, maybe only in 10 years. But I think the big crisis is still ahead of us.
That brings me to the question about India, Dr. Faber. Where does that fit in your preferred or not preferred list right now of markets?
The Reserve Bank of India has one of the best monetary policies in the world because they supervise the financial sector very closely. They have maintained relatively tight monetary policies. And also they pay attention not only to core inflation, which is not representative of the cost of living increases, and it's not representative of inflation in the system, but the Reserve Bank of India also pays attention to rising asset prices and falling asset prices. So I have to give them credit for being actually one of the best central banks in the world.